Professors FM.
I'm Bridget Stomberg.
And I'm Lisa DeSimone.
And this is Taxes for the Masses.
Today's episode is on Nvidia CEO Jensen Huang's estate tax planning.
In December 2024, the New York Times ran an article on the estate tax planning of Nvidia CEO Jensen Huang, alleging that the mogul engaged in complex but legal strategies that could save his estate about $8 billion in taxes. In today's episode, we discuss these techniques. Hello, Lisa.
Hello, B.
We are talking about many things today that make my head hurt.
Oh, well, okay. That's not good. Should we not do episodes on things that make your head hurt?
I don't think we can go for that plan because that would really limit our topic choices.
Okay.
So instead, I may just put my head down for a little while, maybe take a little nappy.
Okay, yeah. We should definitely not be doing episodes on things that make you want to nap. If you want to nap, just think about how our listeners are going to feel about this.
Okay.
This does not seem like a good business model.
I'm sorry, we have a business. We have a business model?
I mean,
does that mean, do we have a business model that's going to enable us to make money?
I make no promises.
Maybe we should do an episode on our business model that is going to lead to us making money.
Okay, shh. You seem tired.
As my child is fond of saying, don't tell me that I'm tired. You do not know how my body feels.
Okay, we are grumpy today.
Well, yes, because we're going to talk about a lot of things today that make my head hurt.
Okay, it can't be all bad. I feel like we have pretty reasonable bite-sized goals for today, right? Bear with me.
Okay, please, go ahead.
1, we're going to try to recap how the estate and gift tax works. We'll do that pretty quickly.
Sorry.
2, we're going to discuss pros and cons of having a robust estate tax as part of the tax system.
Okay.
And 3, we're going to understand 3 strategies used by Jensen Huang that were recently the subject of a couple of articles by Jesse Drucker at the New York Times.
Okay, some of that didn't sound so bad.
Ringing endorsement.
Number 2 didn't sound so bad. And it's likely that my head isn't really going to start hurting until we get into number 3, the weeds of those tax planning strategies. So I will save nap time for then.
That's incredibly generous of you.
You are welcome.
Okay, since you're here and awake and all, why don't you be the one to remind our listeners how the estate tax works?
Is this the time when I should say that I got a 48 on my estate and gift tax midterm in grad school?
Shh, maybe just put your head down.
And it was
nappy time.
Out of 100. But here's the best part. I had the highest score.
See, you left that out. You're clearly a stellar expert in this area. And you can teach our listeners a lot.
You don't need to outrun the bear. You just need to outrun your friends. Okay. So the first thing that I sort of kind of remember from Jesse Boyle's estate and gift tax is that in the U.S., we have what is called, or what you can think of as a combined estate and gift tax. Mm-hmm. Okay. So what that means is that there could potentially be a 40% federal estate tax, but that's going to be a tax on all the gifts that you make when you die, which is what we think of as an estate, but also on all of the gifts that you make during your lifetime.
Yep.
However, there are some really big exclusions to what is going to get taxed at that 40% rate. And I mean big, huge.
Yes. And we've said this on prior episodes. These exclusions are so sizable that these days less than 0.2% of estates pay any estate taxes when they die. Not 2%.
No.
0.2%.
Yes.
Currently in 2025, someone can give away almost $14 million during their life and at death and still not pay any estate tax.
And you said that's one
Yes.
person. So
one person.
If you are married and you are a 2-person married couple, you can give away twice that amount. So $28 million during your life and at death with no tax.
And that's on top of an annual gift exclusion of $19,000 on a person-to-person basis. It doesn't even count at all towards that $28 million per couple.
No, and when we put this episode together, I was like, oh, we should do an example to show like how much that could be. But you can't, because it's $19,000 per person to every other individual person. So it's almost infinite, the amount of money that you could give away.
Yes, as long as you find enough people willing to receive that money.
I will sign up to be a recipient. Anyone out there looking to use their gift tax exemption, give me a call. It's a lot of
We
dough.
appreciate your sacrifice.
I'm here for you, because that's a lot of money.
It is. It is. And while the current level of exemption is slated to revert back to just $7 million per person,
Aw.
or $14 million per couple.
I mean, I guess it's a big change because it's dropping by half, but it's still $14 million per couple.
It's still $14 million.
Yeah.
Yeah. So it would drop in half if Congress doesn't take action this year. But this is one area you can bet Republicans are extremely likely to get something done. Just about everyone expects them to extend the current $28 million per couple exemption before the year is out.
Yeah. So Trump does not like estate taxes because he doesn't want to pay them.
Yep.
And, you're pointing out, we're talking about Congress. The Republicans have the trifecta, right? They've got the House, they've got the Senate, they've got the presidency. So Trump doesn't like estate taxes. The Senate Majority Leader, John Thune, has been trying to get rid of the estate tax altogether for the past 30 years. He likes to call it a, quote, death tax, and claim that it unfairly burdens, wait for it, family businesses and farms.
Yes. Excellent. Good. All right. So we've moved on from briefly recapping how the estate tax works to now our second goal of the day, which is discussing the pros and cons of the estate tax. And a big con is that it could cause families that have a bulk of their wealth tied up in a family business or a family farm to have to liquidate said business in order to pay the estate tax.
True facts. So when you think about your estate, it might not just be cash, right? It might be property and illiquid assets.
Yep.
But when you die, Uncle Sam wants his cash money.
Yep.
And so if your wealth isn't held in liquid assets, that could mean having to sell some of your family business or farm to cover the tax bill. Mm-hmm. Question for you. We all care about working people. We all care about farmers. But how much are we crying over a family business or a family farm that is worth more than $28 million, having to liquidate some part of it? Because not necessarily all of it. You might have to sell a tractor or two in order to pay your taxes.
Yeah, I think that's a really fair question. I'm not crying at people who, have to liquidate above $28 million because they have more than $28 million.
I would cry if somebody gave me $28 million.
Why would you?
Tears of joy.
Tears of joy.
Only way I'm crying over $28 million.
The problem is that a classic middle America argument is that farms rely on economies of scale to remain profitable. So selling any part of the business could cause a farm to go from profitable to unprofitable.
Okay.
Now, as a non-farmer, I have no idea where that inflection point is, right? If we go back to the legislated exemptions that are set to kick in 2026, which we think are not going to kick in, as we've already said, but they are legislated to go back to $14 million per couple as the exemption. Are we crying for those farmers?
Okay, so I like where your head's at. If you have to sell part of the business, maybe that's going to be detrimental. So all fair questions. You're not a farmer. I'm not a farmer. We don't come from farming people. So when all else fails and we don't have personal knowledge about stuff, I have now started asking ChatGPT.
Okay. All right. And what does the robot tell us?
So the robot says that the average farm in the U.S. is worth $2 million.
Well below the old $14 million exemption and the current $28 million exemption.
And let's be clear, listeners, that doesn't mean they'd have to pay 40% tax on $2 million. Until you get over that exemption limit, you owe zero estate tax.
Yes.
So the average farmer on an average U.S. farm worth $2 million would not have to liquidate any part of his farm because there would be no estate tax.
Agreed.
Now, who knows if that's right? Because like you said, I asked a robot. I would ask a farmer if I knew a farmer, but I don't know any farmers. Maybe our listeners can crowdsource this for us.
Oh, yeah, that's a good idea. Farmers only, though, please, listeners. Reach out.
Okay. Wasn't that a dating app?
I wouldn't know. I haven't been on the apps. Have you?
No, but I remember commercials for farmers only that would run, ironically, during Wheel of Fortune. So, yeah, maybe this isn't the best strategy.
Okay, fair enough. Moving on. Other reasons people hate the estate tax. I mean, it's a tax, right? And people tend to hate taxes for a variety of reasons. Another reason that people cite, it causes people to do tax planning, as pretty much all taxes do. And it could also impose really large compliance costs, not only on taxpayers, but also on the tax authority.
So in a shocking twist of events, you just said everything that was bad about the estate tax.
Yes.
And I'm going to sweep in and talk about all the things that are good.
Who are you? What year is this? Where are we? What's going on?
And I hate estate taxes, but here we are. But the big benefit is that it actually can help mitigate income inequality, particularly those that are perpetuated by the transfer of intergenerational wealth.
Yes. And in my opinion, one of the more fascinating aspects of Jesse Drucker's New York Times article on Nvidia CEO and estate taxes was the part where he cited big thinkers from history who have been in favor of an estate tax. And the one that really jumped out at me, Adam Smith.
Okay, so I didn't read the article, but are we talking about like the Adam Smith, like father of the invisible hand and laissez-faire economics Adam Smith?
Yeah, the very one.
Okay.
The same guy who gave us some of the original thinking on how free markets will, always sort themselves out without government intervention, evidently did not much like inherited wealth to the extent that he argued heavily in favor of an estate or inheritance tax.
That is fascinating.
Yeah.
And it turns out he's in good company because a non-trivial number of rich people also support estate or wealth taxes, which I find equally fascinating. So Warren Buffett, for example, who I've heard has a decent amount of wealth, recommends only a $4 million exemption per couple, which is far lower than what we currently have or what we expect to see in coming years. And it's, not just, we can find some people in between Adam Smith and Warren Buffett, right? So Andrew Carnegie was also in favor of a large estate tax.
And with all these arguments floating around with good people on both sides and all that, it's worth repeating that fewer than 0.2% of estates currently pay the estate tax. As Gary Cohn, who was Trump's chief economic advisor during his first administration, eloquently put it, and I quote, "Only morons pay the estate tax."
That's just not nice. All right. It's probably worth pointing out that tax revenue from the estate tax really have kind of stagnated in the past 25 years, despite the fact that Americans are getting far wealthier. So reasons for that, one of them we have been talking about is a rise in the estate tax exemption.
Yep.
Another one is reduced IRS budgets, and that's relevant because, as we said, a lot of times the state is tied up in non-financial or illiquid assets that are hard to value, and if the IRS can't come in and challenge your valuation, they might lose out on some estate tax. And then the other one that you mentioned as being or contributing to some inefficiencies is the rise of estate tax planning.
Like those strategies used by Nvidia's CEO.
Because apparently he's not a moron.
Apparently not. Our last goal for today is to understand 3 strategies used by Jensen Huang. And since my co-host has threatened to nap through this section of the pod, I'm going to suggest we keep things pretty high level here.
I agree that is a wise choice, and I thank you, but I make no promises that I will, in fact, stay awake.
Yeah, it doesn't help that the 3 strategies make for a really infuriating alphabet soup. We've got the IDGTs. Some people call them idiots or idigits.
Oh,
we've got GRATs, GRATs, and we have DAFs or DAFs.
Lord help us.
Yeah. It doesn't have to be that complicated, though. So I'm going to boil it down to 2 primary mechanisms people use to avoid the estate tax. Mechanism number 1, give away highly appreciable assets early before they appreciate. And mechanism number 2, give your assets to charities.
Okay, you're right. That is fairly high level. I can deal with that. So the first thing you said was give away highly appreciable. So things that can increase in value over time. Give those things away before they do appreciate in value. It feels logical. Like I've got a spidey sense that it's a good idea, but can you explain specifically why it works in the context of estate and gift taxes?
Sure. Yeah. The strategy is basically a way of managing that lifetime gift and estate exemption. If you can only give away $28 million as a couple during your life, and I use only here very loosely, then you'd rather give away appreciating assets early in life rather than late in life or upon death.
And that makes sense because they're appreciating, they're appreciable. That means they're going to be worth more later in your life. And at that point in time, you might not have enough of an exemption left to cover the gift or bequest. So if you give away something today that is only worth $100,000, that's going to eat up a lot less of your lifetime exemption than if you wait and give it away when it's worth $100 million.
Exactly. So the first two strategies that Jensen Huang used take advantage of this premise. They just kind of supercharge it. Not only do they get the assets out of his estate at a lower valuation, thus managing his exemption, but they also allow him to kind of multiply the amount that he's giving away through the use of loans or annuities.
Okay, so I'm gonna give this a go here. Deep breath. So let's start with that first strategy you mentioned, the IDGT or the IDGIT. Is this how people say it?
I've heard I dig it or IDGIT. I don't know.
Geez. Okay. Well, it stands for intentionally defective, which you gotta love. Mm-hmm. Intentionally defective grantor trust. I think I'm intentionally defective. I got far enough along in researching this episode. I'm sure I learned this in grad school, but it didn't come back. But anyway, I've got far enough along to understand that not only do you need to put appreciable assets into your trust early for this to work, you want to get them in there before they've exceeded your exemption for sure. But in addition, you can put way more than the value of your exemption into the trust by loaning funds to the trust to buy more assets out of your estate.
Exactly. And we'll just give a quick reminder here about what a trust is. It's just a way of changing the ownership of your assets in a way that preserves them for someone's future benefit. Because of this, trusts are a huge estate planning tool because you might know who you want to receive your assets at death. So you can go ahead and put those assets into a trust now for that person's benefit, and they don't actually even have to get use of those assets until after your death.
Yeah, so I mean, I want my child to eventually have everything. I don't want to give it to her until she has a fully formed brain.
Yes. And the GRAT or the Grantor Retained Annuity Trust works on the same principle. Put those assets into a trust now for the benefit of your beneficiaries later upon your death. The way this strategy multiplies the amount that you get out of your estate is that in return for putting your assets in the trust is going to agree to pay you out the discounted value of those assets as an annuity over a fixed period of time.
Okay, so this one was not as straightforward to me because if I'm going to give stuff to a GRAT and then it's going to give me back the same amount that I put in, at least in expected value, it was less clear to me how this is beneficial.
Yeah. So remember, you expect those assets to appreciate over time. So what you put in may be worth, say, $20 million today, and the agreement is that the GRAT is going to pay you back that $20 million over the next, say, 10 years. But over that same amount of time, those assets could grow to be much, much more than $20 million in value.
Got it. So what it's repaying you is the value of the assets that you put in as valued on that date and time. They're not catching up as the assets appreciate.
Exactly.
Okay. So you still get a lot of value left in the trust for your beneficiaries.
Indeed, you do.
Okay.
And because you put in $20 million and expect to get $20 million back out, actually on a net basis, you didn't make a gift of any value at all to the trust. So you haven't used any of your estate and gift tax exemption.
That is really clever.
It really is.
Okay. So these, I'm going to call them IDGITs because it rhymes with Bridget. These IDGITs and these GRATs help you get a lot of value out of your estate while minimizing the use of your exemption. So it's a win-win. All right. The third strategy that you talked about is a way to give your money to qualified charitable organizations. So you said there were two overarching goals. One is get appreciable assets in early. The other is give your money away to qualified charities. That is also going to get the value out of your estate, which reduces your estate taxes. And added benefit here is that you might actually get a giant tax deduction when you make the donation to reduce your income taxes.
Exactly. And we recently did an episode on DAFs or donor advised funds that make it easier for you to give away your appreciated stock holdings. According to the Times, Jensen Huang also made use of DAFs as his third estate planning strategy.
But that episode we did on DAFs talked about the dark side of DAFs. So not giving those shares to charities right away is an example of one. The DAF can basically hold on to those shares before it makes the donation. There's also some, shall we say, lax reporting on how those DAFs actually give away their assets and when they do. And then finally, there's the potential that the DAFs are going to use those funds to support non-charitable organizations. In particular, I think we found that there was a lot of evidence that DAFs are being used to fund like hate organizations and things like that.
Yepers.
So much for doing a good deed by giving your wealth away to charity.
Yeah, it's pretty yuck.
right, it is time for the good, the bad, and the ugly. And I stayed awake the whole time. I don't know if that's good or bad, but I stayed awake.
I think that's super good.
Okay.
Yes.
I was awake. I learned a lot. And when I took estate and gift in college, we had to learn everything out of the regs. Maybe if I had you or someone like you summarizing things for me at a high level, I would have retained some more knowledge.
Maybe if you had ChatGPT.
Absolutely. But anyway, learned a lot. You made estate and gift taxes seem a lot more accessible. So thank you.
You're very welcome. I enjoyed this episode, and I enjoyed thinking through the reasons why people on both sides can make arguments as to whether we should or should not have an estate tax, or maybe have something different like an inheritance tax or a wealth tax, which we didn't get into, but I think it's interesting to have a balanced debate.
Yeah, this is actually one, I have a pretty solid opinion on most taxes. This is one where I've also kind of gone back and forth, because to me, the thing, with some exceptions, like it does feel like there's a little bit of like a double tax element to it, right? Like if somebody paid tax on it at one point in time, I can see an argument for like, why do I have to pay taxes on it again just because I'm transferring it? But there's lots of other good reasons too. But I do think it's interesting, because this is one of the taxes that I kind of waffle on as well, especially since, as you pointed out, the way it's currently designed and implemented, nobody's paying it anyway. Only morons. Yes,
only morons are paying it. And that, I think, brings us to going into the bad here. This is a really complicated area where smart nerds have been able to jump in and come up with complex strategies to avoid the estate tax.
100%. I always felt, maybe because it felt less accessible to me, that like this was a place where tax specialists were really helpful. And if you knew to go consult a tax specialist, you could really get ahead in this area more so than maybe some other areas.
Yeah, so this is one of the things that that article in the Times pointed out, is that a lot of these strategies were not intentionally made legal. It's not like Congress said, oh yeah, let's create this thing called an IDGIT or a GRAT. No, a lot of creative lawyers put them together, and it's been more a matter of an inability on the part of the IRS to enforce them, and an inability or unwillingness of Congress to close down these loopholes.
That's a great point. Just because something has a weird fancy acronym doesn't mean that Congress approved it.
Right. If they did approve it, it would have an acronym that probably spelled something like moron or sucker or something like that, right?
Die. Okay, ugly.
Yeah.
Okay, so politically speaking, I would say that instead of having a legitimate, rational, informed debate about the merits of an estate tax, whether we should have one or not, what we are more likely to see is a sort of tug of war back and forth between lowering the exemption, raising the exemption, and it just flip-flops depending on who's in charge for that 4-year period of time.
Sounds like so many things in tax land these days.
It's everything.
But yes, I agree. Yep. It seems as if gutting IRS funding has also been a really convenient strategy that Republicans have used to basically take the teeth out of the estate tax, right? There are far fewer audits now of estates than there were 25 years ago. If you go back to the 1990s, about 20% of estates were audited, and now it's about 3%.
Oh my gosh. Okay. Yeah, that's a tiny number.
Tiny number.
And why even have it if it doesn't affect anyone? And honestly, the people who are doing it, like, I'm not going to call them morons, but like, are they just poor schlubs and they just didn't realize that nobody else is doing this?
I think there are some people that probably aren't aware of all these strategies or think they're too aggressive or too expensive. But then on the flip side, we did an entire episode on the Patagonia owner's family and how they intentionally structured their estate to pay more taxes. Now, don't get me wrong, they did estate planning. They certainly saved themselves some taxes, but they could have done it in a far more tax aggressive way, and they explicitly chose not to. So I think there's pretty wide variation out there.
Well, I'm going to say that they are in the minority.
Yeah.
And I'm also going to say, if you want to pay more in tax, nobody's going to stop you, but let's just let the rest of us off the hook.
I'm not going to say let the rest of us off the hook, because I like a functioning government that can pay its bills.
Wow. Okay. Dream big.
I will. Just as soon as we get that nap.
Okay, I was going to say.
Well, that's all we have time for today.
Be sure to join us for more tax nerdery on future episodes of Taxes for the Masses.